Preliminary performance numbers are in for mutual funds in Canada for 2011, and to anyone who's been paying attention throughout the year, it should come as no surprise that most equity fund categories took a beating last year. With few exceptions, the Morningstar Canada fund indices that track equity categories generally posted double-digit losses, with the worst returns coming from the equity categories that track the Asian markets. With me to talk about these results is Morningstar Canada Fund Analyst Adam Fisch. Now, Adam, let's start with Asia. What did the returns look like for mutual funds that invest there, and what were the main drivers of performance?
Well, as you said, there were a number of categories posting double-digit losses, some over 20%. And I think there were a couple of reasons for that. The one that got the most media coverage was, of course, the natural disasters in Japan in March, which we've covered in prior videos. It took a toll on manufacturing facilities there and exports. And really, there's still a lot of recovery to be done on that front. The other driver, I would say, is some of the measures that were taken by the Chinese government to try to cool the economy a little bit and prevent inflation. There were some more restrictions on lending and those sorts of policies that went into place that we started to see the results of around the end of the year. There were some slower manufacturing numbers coming out of the region. And the question now will be whether they can strike the balance between trying to curb inflation and preventing a downturn.
Now, here in Canada, the resources sectors had a hard time. We saw the materials sub-index of the S&P/TSX lose 21% for the year, and the energy sub-index also lost 14%. How did that affect the overall Canadian markets and Canadian mutual funds?
Well, anyone that invests in Canada knows that resources and energy are a large part of our market, and so anytime there's those stocks suffer, there's going to be a downturn in how Canadian mutual funds do. I think there were a couple of reasons. With the European debt crisis, I think there was a lot of investor uncertainty, and investors were more hesitant to invest in smaller mid-cap names that are common in the energy and resource spaces. The other thing that we saw, in spite of certain precious metals performing well, the equities that work in those areas really didn't match up. Gold was up over 10%, but precious metals producers still did not have a particularly strong year. So that would have contributed to some slow performance as well.
Now, as is usually the case when equity funds struggle, we see fixed income funds take over as performance leaders. How did bond funds do last year here in Canada?
Yeah, well, as you said, it's no surprise. Bond funds were among the leaders in the fund category performance, particularly long-term fixed income, inflation-protected fixed income. Investors really not concerned about a rise in rates for the foreseeable future. It seemed generally people were assuming that there's going to be slow growth for a while and low rates, and that bonds were going to be the safest place to try to generate some returns, however small they may be.
Thank you, Adam. And for more on Morningstar's latest survey of fund performance, please click on the link on the right side of the video player. And if you're watching us on YouTube, please visit us at www.morningstar.ca.